Hi, and welcome to Unit 14 of BSS 310. This unit is all about the present worth analysis. This is the last unit that you need to complete your group project. In Unit 13, we spoke about something called the minimum acceptable rate of return, the MAR, also called the hurdle rate. We said that if a project's cash flow can jump over your hurdle, it is said to be financially feasible. So in Unit 13, we spent some time looking at the factors that help us to determine how high our hurdle should be, or what our MAR should be, and in this unit we're going to see how we can determine whether our project's cash flow has jumped over the hurdle. We're going to start by defining cash flows for a certain project. Then I'll show you how to calculate the net present value, or NPV, using Excel. Then I'll also show you how to calculate the expected NPV in Excel when you're considering uncertain scenarios. For your project, you had to come up with a worst case, most likely, and best case scenario, and I'll show you two simple methods of incorporating that uncertainty into your NPV calculation. Then we'll also discuss how we need to interpret the results of a present worth analysis to make conclusions regarding a project's financial feasibility. In the Unit 11 video, from 26 minutes and 47 seconds onwards, I introduced the concept of a cash flow and a cash flow timeline. There I went over the basics of receipts and disbursements, the timing on the cash flow timeline, the perspectives that you take, and there was an extensive example that I used to show you all the different cash flows on the timeline. If you can't remember any of that, or if it's still a little bit vague, I'd recommend that you rewatch that before carrying on. So in Unit 11, I introduced the cash flow timeline. I also introduced the concept of prepaid expenses versus operational expenses. Prepaid expenses are those that are reflected at the beginning of a period, like rent or insurance, and operational expenses are those that are reflected at the end of a period, for example, salaries or maintenance costs. What we'll add today in terms of the cash flow diagrams is how we reflect first costs and how we incorporate a loan and its repayments in a cash flow diagram for a specific project. Let's start by defining cash flows for a specific project. Today, my pet example is the slime factory. Now, I'm sure that you have your own lockdown story to share. My husband and I have been lucky enough to spend the time with family members. So the two of us are currently sharing the house with a family of 6, of which 4 are sparkly little girls under the age of 12. My youngest niece actually just turned 6 today. Something that they are obsessed with is making slime. On all the household furniture and in all the carpets, you can see the evidence of their passion. In fact, they are so passionate about making slime that they have started their own slime factory. It has a specific name and a brand, and they're starting a YouTube channel, but I've promised not to embarrass them in my engineering lecture. That's where I got this idea from. Today's example is all about slime. And to get you just a little bit deeper into my lockdown experience, I would love for you to watch this little YouTube clip so that you can see what I have been exposed to for many days on end. If you really do have an aversion for sparkles and high-pitched voices and bunnies and things that are fluffy, then I recommend that you only watch from 1 minute and 51 seconds up to 4 minutes and 22 seconds to see how to make fluffy slime. If you do feel like really empathizing with me and my lockdown experience, then feel free to watch all 7.5 minutes of it. So let's get right into it. We're imagining that the slime factory is starting from scratch. Similar to the projects that you'll all be embarking on, we have come up with a detailed project plan to set up the slime factory. This project plan had certain activities, a work breakdown structure, a schedule, and so on. And from that, I could deduce the labor cost and the material costs. And I could also factor in different project overheads that I would incur as I set up my slime factory. I had to pay some marketing consultants to help me with my corporate identity and to set up my website for me. I also had some initial internet and cell phone costs. I had to buy computers and specific software to help me with my marketing throughout the lifetime of my business. And I had to install fixtures and equipment in my garage where I will be making my slime. My total project cost is 113,000 Rand. This is my first cost. It's the cost that I have to incur before I can start my business. On a cash flow diagram, we indicate our first cost at point 0, at the start of the first year. Because it is a cost, it is a downward arrow. Again, I'm reflecting all my cash flows on my cash flow diagram in thousands just to make it easier to display on the cash flow diagram. But we don't have 113,000 Rand to invest in our business up front. We don't have that kind of capital in our back pocket. So what we did is we went to the bank to get a loan. These are the terms of my loan. The bank agreed to lend me 80,000 Rand. That's my principal amount. It's the amount that the bank will pay out to me today so that I can use it in my business. Let's assume for simplicity's sake that the repayment periods are years, so I only have to make one repayment every year. There are only 3 repayment periods, so I have to repay this loan of 80,000 Rand in 3 repayments, each payment happening at the end of a year. The interest rate that the bank has charged me is 16% per year, compounded annually. We reflect this 80,000 Rand as a receipt on the cash flow diagram at the beginning of year 1, because that's when I receive the money from the bank so that I can start with my business. Remember that we're looking from the perspective of the borrower in this case. I have borrowed money from the bank, and therefore the money came into my business as a receipt. That's why it's an arrow above the line. Next, we need to figure out what our yearly repayments would be. If you were to take out a loan with a bank, they would calculate this for you. And in fact, there are many online calculators that you can use to calculate repayment schemes for different types of loans, vehicle loans and mortgages. Every single one of our commercial banks has an online calculator that you can use. What I want to show you today is how you can calculate it for yourself just using a function in Excel. The function that we use in Excel is called the PMT function because it calculates the payment of a loan. Pretty neat. The function has a couple of arguments. The first one that it asks for is the rate. That's the interest rate that the bank has charged you. Very importantly, this has to be the rate per period. This 16% is per year compounded annually, and our repayment periods are in years. So it's correct to put the 16% in here unaltered because our number of periods will also be in years. So NPER is for number of periods, and we put in there 3. PV is present value. That is the value today of your principal amount. So we put the 80,000 in there. FV stands for future value. That's not something that we deal with in this example, and that's also not something we'll necessarily deal with in BSS 310. If you, for example, had a balloon payment at the end of your financing plan, as many vehicle financing plans have these days, you would have had something to put in the FV argument. But for now, we'll just leave it blank. Type is an argument that you use in Excel to specify whether a cash flow is at the beginning or the end of a period. The default value says that cash flows are at the end of a period, which is what we want here. If we calculate this function in Excel, it shows us that our yearly repayments are 35,620. The brackets in Excel indicate that it's a negative number. So I've rounded that up to 36,000 to put it on the cash flow diagram. These are the cash flows related to my loan. I have a principal cash flow, which is always a receipt, and then I have to reflect my equal annual payments to repay the principal amount at an interest rate of 16%. Let me show you what this looks like in Excel. I've created this Excel workbook, the Slime Factory, which will be distributed with this video and the slides on ClickUp. On the first tab, you'll see the project budget that I showed you on the slide. On the second tab, you'll see an income statement that we'll get back to. In the third tab, you will see the loan information I've just presented to you. Let me show you how to calculate the yearly repayments. I can either just start typing PMT, and if I feel confident, I can enter the arguments. But for now, let's just use the formula wizard. I go to Formulas, Financial, and scroll down until I find the PMT function. This opens up a side pane, which is really neat because at the bottom it gives you descriptions of what each argument is for. The rate is the interest rate, so I click on that cell. The number of periods is 3. My present value is the principal amount, and I can leave the FV and type fields blank. I click Done, and it calculates my repayments for me. I just want to point out that I'm using Excel on a Mac, and I have stuck to the default syntax. So I have a semicolon separating my arguments, and I have a comma as a decimal separator. If you're working in a Windows environment, you would have commas separating your arguments, and you would have a decimal point. The next set of cash flows we need to look at are our recurring cash flows. I've developed a projection of my income statement for the next 6 years. At the top of the income statement, I show the revenue that I expect to earn from the sale of my slimes. I subtract the cost of goods sold, and that results in my gross profit. Below that, I reflect my operating expenses for the year. I have rent, maintenance, internet and data, and salaries. My operating expenses together are 51,000 Rand for year 1. I subtract my operating expenses from my gross profit to give me my net income. Now, if all my operating expenses listed here occur at the end of a period, then I could have just put that 29,000 on my cash flow diagram. But this expense line over here, my rent, is actually a prepaid expense, which has to be reflected at the beginning of the period when I work with cash flow diagrams. So because of this little scoundrel, I have to go to a little bit of extra effort to reflect my recurring cash flows on my cash flow diagram. Let's start with the prepaid expenses. I will pay 24,000 Rand for my rent for the year at the start of year 1. In the same way, I will pay my rent for year 2 at the start of year 2. And fast forwarding to the end of the timeline, I will pay my last rent account of 32,000 odd Rand at the start of year 6. At the end of year 6, I don't have any rent because this is the end of my project timeline, and I've already paid rent for this period over here. Next, I want to reflect the rest of my operational expenses. If I add up my maintenance, internet and data, and salaries, that amounts to 27,000 Rand in year 1. I reflect that at the end of year 1 because I incurred these expenses as I went through the year. If we wanted to be 100% accurate, we'd obviously have to reflect these expenses as they occurred, which probably would have been monthly. But in this case, to simplify the problem, we are working in yearly increments. If we fast forward right to the 6th year, we'll see that our very last cash flow of 39,000 is all the operating expenses that we incurred during this 6th year. The last recurring cash flow that we want to show is our gross profit. This is a receipt and not a disbursement, so the arrows are above the line. The gross profit is also reflected at the end of the period because it is earned throughout each period. If we were to put all of these cash flows together on one cash flow diagram, it would look like quite a mess, but we can simplify it. Let's calculate the net cash flow at each point in time. At point 0, I have my first cost, which is a negative number, my prepaid rent of 24,000, no operating expenses or gross profit, remember that's over here. I have the principal amount that I've received from my loan and no loan repayment yet, which gives me a net cash flow of negative 57,000, so a cash outflow of 57,000. I no longer have my first cost, that's been reflected, so I don't reflect that ever again. I again have prepaid rent. I have my operating expenses for my first year. I have gross profit, which I've earned throughout my first year. I don't have any more money coming from the bank into my pocket, but I have to start repaying my loan. So I have this loan repayment at point number 1, the end of my first year. And if I add all that together, I have a net cash outflow of 8,000 Rand, which is reflected over here. In fact, only at the end of my 3rd year do I have a net cash inflow of 4,000 Rand. And once I've paid off my loan, that inflow then increases substantially until my final net inflow is nearly 100,000 Rand at the end of year 6. This is a simplified cash flow diagram, which we'll use to calculate our net present value. Why is it necessary to calculate a net present value? Why can't we just look at this cash flow diagram and see whether the project is financially feasible or not? I mean, after all, if we add up all these numbers, we end up with a positive 141,000. So isn't it just fair to say that this project made us 141,000 Rand? Well, not really. Is that 141,000 Rand in today's terms or in the money value of 6 years' time? What does that 141,000 Rand mean in terms of buying power? You're old enough to have experienced the decrease in the purchasing power of money. If you don't know what I'm talking about, just think back to what a can of Coke used to cost when you were in primary school. This is the concept of the time value of money. It simply says that over time, the purchasing power of money decreases, so that 100 Rand today doesn't have the same purchasing power as 100 Rand 10 years ago. Because the purchasing power of money changes over time, we can't just add up cash flows over time for an accurate picture of a project's finances. We need to account for the rate at which money is losing its purchasing power. That is why we calculate the NPV. To calculate the net present value, we have to bring each one of these future cash flows back to today, which is this point 0 on your cash flow. This first cash flow of negative 57,000 Rand is already in today's terms, so I don't need to do anything about that. But for every other cash flow on this diagram which occurs in the future, I have to convert these cash flows to their equivalent value in today's terms, today's purchasing power. How do I do that? I need to know what the right interest rate is to bring them back to today. Once I've brought all of these values back to 0, I can calculate the net present value. If the net present value is larger than 0, that's good. If the net present value is smaller than 0, that's bad. But how do we determine which I to use? Remember our analogy of the ladies jumping over the hurdles? Let's imagine for a moment that this I, the hurdle height, is just the inflation rate in South Africa. So I just want to make sure that this project's cash flow will increase the purchasing power of my money over time if I consider inflation. So if I set this hurdle at the height of the inflation rate, and I then have a positive NPV after I've brought all my cash flows back to 0, that means that I'll be outperforming inflation. However, if I set this hurdle height at the inflation rate and my net present value is negative, it will mean that this project's finances is underperforming inflation, which means that in essence I am losing purchasing power. But how do we do that? So let's imagine that our I is inflation, which at this point, when I googled it today on Statistics South Africa, the CPI was 4.6% year on year, which means on average consumer prices increase by 4.6% year on year. Now let's first take this example of the 8,000 Rand disbursement that I want to bring back from the end of year 1 to the start of year 1. This is the formula that we'll use. The present value of a cash flow is the future value divided by 1 plus I to the power of n. Many of you might recognize this formula from school. So if I want to calculate the present value of this first cash flow, which is 8,060 Rand, negative 8,060 Rand, I divide that by 1 plus 0.046, so that's my inflation percentage, to the power of 1, because I'm only bringing it back one period. The answer is negative 7,706 Rand. That means in today's terms, this cash flow is worth 7,706 Rands. Let's do one more example. This positive cash flow over here is 47,626, which I've rounded up to 48,000. If I want to bring this cash flow back to its value in today's terms, I have to divide the 47,626 by this term, 1 plus 0.046 to the power of 4, because I am bringing it back 4 periods. That gives me an answer of 39,785. These are the fundamentals that underline the calculation of the net present value. But thanks to Excel, the process has been greatly automated. So let's have a look how to do it in Excel. The fourth tab in the Excel workbook says NPV calculation. Here's the table that you've just seen on the slides. Here I've typed in my inflation rate, so the height of the hurdle that I'm using. And in this cell, I've calculated my NPV. Let me show you how to do that from the start. I go to Financial Formulas, select NPV, and fill in the arguments. The first argument asks for the rate, so the height of the hurdle, which in this case is my 4.6%. The second argument, or the series of arguments that follows the rate argument, are the cash flow values. I can do this one of two ways. The one important thing to remember is that this first value has to be at the end of the first period. So I can't put this 57,000 into my NPV formula. I'll show you how we incorporate the 57,000 in just a minute. The one way in which I can use this NPV formula is to list each value separately. So I can go and click on my first value, go to the next field, select my second value, until I have reflected all of my values. I can then click on Done. This gives me the net present value of all of these future values. I still haven't incorporated the cash flow today. To do that, I can simply add it to my formula. That's the one way of calculating the NPV. Let me show you a different way. Using the same formula builder, I select my rate, and then when my cursor is in this value field, I can just select all of the values. Excel will interpret this as each value occurring at the end of each subsequent period. I can click on Done. Remember that I still have to reflect my negative 57,000, so I go ahead and add that to my formula. That's how you use Excel's formula builder to calculate the NPV. Pretty simple. So let's do a quick recap of the rules when we calculate the NPV using the formula builder in Excel. Always remember that the cash flow at t equals 0 is not included in the NPV formula builder. You have to add it yourself manually. Rate is the interest rate, hurdle rate, MAR, or inflation, whichever parameter you're using to determine the height of the hurdle. The rest of the cash flows which you reflect in those fields that say value 1, value 2, have to occur at the end of subsequent periods. And that's it. So let's see how we should interpret the results from this NPV calculation. We have a positive NPV of 98,000. It's actually very positive. What that means is that this lady has jumped over the hurdle with quite a large clearance. But to interpret this result, we have to remember what the hurdle height represents. We use the inflation rate as the hurdle height. So we just wanted to see whether this project's cash flow will make our money grow at least inflation. The fact that the NPV is positive tells us yes, but what if our hurdle height was not inflation, but instead it was the MAR of our company? Surely our company is slightly more ambitious than just growing our money by inflation, just keeping up with inflation. We want to make money. We want to have more money and more purchasing power in the future than we have today because of this project that we've embarked on. For this example, the slime factory, I'm using a MAR of 18%. If I calculate the NPV using the MAR as my rate, in other words, I've used the MAR as the height of my hurdle, then my answer is 23,430. That is positive. It means that the athlete has jumped over the hurdle when the hurdle was set at 18%. This is a good thing. What can we say about the fact that the NPV down here is different to the NPV up here? Here's a common misconception about the NPV. Students often think that the NPV is an indication of the profit that we've made in the project. That's not true at all. The net present value shows the clearance by how much your athlete jumps over your hurdle. If the NPV was 0, it didn't mean that we didn't make any money. That would simply have meant that we made exactly 18% return. In the same way, if my NPV was negative, it wouldn't necessarily mean that I didn't make any money. It would just mean that I did not make 18% return on my project. This brings me to the following concept, the relationship between the MAR and something called the internal rate of return. We can calculate the internal rate of return in Excel. Under the library of financial formulas, we look for the IRR function, and it requires a set of values. These would be our cash flows. The IRR formula is different to the NPV formula in that I can include the cash flow today at the start of the first period. So I go ahead and select that entire range of net cash flows. You'll see that there is a field called guess, and in there you could insert your guess of what the internal rate of return is. The reason why Excel asks for this is because the IRR function is actually an interpolation function. So oftentimes it is helpful in terms of calculation time to insert a guess for Excel. But the cash flows that we're dealing with aren't nearly as complex. So for our purposes, we don't need to insert a guess here. Here the result shows that the IRR is 26%. That means that this project will earn me 26%. That's the actual rate of return. So a different way that we could use to consider whether a project is financially feasible or not is to compare the IRR to the MAR. So think of it this way. If we go back to our analogy of the hurdle athletes, if there was no hurdle and we just asked those athletes to run and jump as high as they possibly could, and we measured the distance from the ground to the athlete's leg, that would be their IRR. And if we compare that distance to the height of the hurdle, obviously if they can jump higher than the hurdle height, they would clear the hurdle. If we make the MAR equal to the IRR, which isn't a solid 26%, it's actually, if we have a look at it, it's 25.60%. But if we use that as the MAR, then our NPV is exactly 0. So that's the comparison between the IRR and the MAR. We're focusing on present worth analysis to determine the NPV, and we then see whether the NPV is positive or negative to determine whether a project is financially feasible. But you could also compare the IRR to the MAR, as I've explained. If you click on this link, it takes you to a really good explanation of the hurdle rate versus the internal rate of return. If you're still not really clear on the concepts, I suggest that you go ahead and read that. Next, we're going to look at how we calculate expected NPVs in Excel when we have uncertain scenarios. Remember that one of our previous units dealt with the concept of risk and risk analysis and coming up with different scenarios for your project? Well, under different scenarios, you might have different financial outcomes or different cash flows resulting from those scenarios. For the slime factory, I've come up with 3 different scenarios. On the scenarios tab, you'll see these colored blocks for worst case, most likely, and best case scenarios. To the left of this black divider, I have developed 3 scenarios for my first costs, or let's call it my project startup costs. The numbers in my most likely case are the numbers that we've evaluated previously. Then I developed a worst case in which my marketing consultants charge me double of what I've budgeted, and the fixtures and equipment just cost a whole lot more than I thought they would. So under the worst case scenario, my total project cost is 163,000 Rand compared to the 113,000 Rand I initially planned. Under the best case scenario, my marketing consultants bill me for less than I had budgeted. I can get a really good deal on computers and software, so that cost is cut by 4,000 Rand. And my fixtures and equipment are also a lot cheaper than I had planned. So under the best case scenario, my total project cost could be 94,000 Rand. So I have these 3 different scenarios for my first costs. To the right of the black divider, I've developed 3 scenarios for my running costs. Specifically, I've varied what happens in terms of my revenue and cost of goods sold. Again, the most likely case are the numbers that we ran previously. For the worst case, I assumed that I would sell far fewer units of slime, and that the cost of goods sold to revenue relationship would also vary. That would in effect change my gross profit numbers. Under the best case scenario, I assumed that I would sell more units of slime, and again that my cost of goods sold to revenue relationship would vary, and this resulted in a different gross profit calculation. So these are the 3 scenarios that I've defined for my business. How do I now reflect these different scenarios in my calculation of the NPV to determine whether this is a financially feasible project to embark on? We'll be looking at 2 very simple techniques of calculating an expected NPV. The first technique, which I've called the simple expected value technique, assumes that there are uniform probabilities amongst the 3 scenarios. So the 3 scenarios are equally likely of occurring. It also assumes that there are only 3 combinations, so you can only have the worst case of the first cost and the worst case of the gross profit, most likely case of first cost and most likely case of gross profit, or best case and best case. So only those 3 combinations. I imagine that you can already think of different types of combinations. Why can't we have the worst case in terms of the first cost with a best case running cost scenario? Because certainly the factors that affected those 2 scenarios are different, so you could have them occurring at the same time. And you're absolutely right, but for this very simplistic calculation, let's just assume that it can either be all worst case, all most likely, or all best case. In the spreadsheet to the left of the black divider, I've evaluated the expected NPV based on that very simplistic approach of uniform probabilities and simple scenarios. What I've done is I've repeated my NPV calculation for each one of these scenarios, factoring in the different first costs and the different gross profit numbers. Under the worst case, you'll see that my NPV is actually negative 121,271. That means that if the worst case is realized, this project is definitely not financially feasible for my company. The NPV under the most likely case is the NPV that we calculated previously, 23,000. So in that case, it would be financially feasible. And if the best case materializes, my NPV is 133,000. So that is a fantastic clearance above my MAR, and this would definitely be financially feasible. If we assume uniform probabilities, we calculate our expected NPV by simply adding the three NPV values and dividing it by 3. In this case, the expected NPV is still positive 11,929. So your answer would still be to go ahead with the project because it is financially feasible, even though there's a risk of earning far below 18%. Another slightly more sophisticated approach, which is often used in project management estimations, is based on the beta distribution. This is a sort of a rule of thumb that is used in project management to calculate expected values of schedules and of costs. In this sense, we assume that the most likely scenario is 3 times more likely than either the worst or the best case scenario. And we find the expected value of each parameter individually. So this is the formula that we'll be using. The mean value of any parameter is the worst case value plus 4 times the most likely case, and we add the value of the best case scenario. Let's see what that looks like in Excel. To the right of the black divider, I've now executed this approach. The two values that vary with my scenarios is my first cost and my gross profit. So I don't need to do any calculations with the rest of the numbers in this table. In my first cost, I've gone ahead and added the worst case scenario value plus 4 times the most likely case scenario value plus the best case scenario value, and I've divided by 6. So then my mean value for my first cost is 118,000. I've done the same for each value of gross profit. The worst case plus 4 times most likely plus the best case divided by 6 to come up with mean values for the gross profit realizations each year. Now go ahead and calculate the NPV using these mean values. The NPV is still positive. That makes sense because we've now given more weight to the most likely outcome, which was positive in the first place. So it makes sense that the expected value for the NPV using this approach, the beta distribution, is more positive than the NPV that we received when we assumed that the worst case is equally likely to the most likely case. These are two very simple ways to account for uncertainty in cost calculations. You can refine this approach a lot more if you could define certain probabilities for outcomes. You could then look at the concept of joint probabilities and calculating joint probabilistic outcomes when you calculate your expected NPV. You could also look at decision trees and alternative decision-making paths, but those types of techniques are only really valuable if you have very accurate information. It's no use using a very sophisticated technique when most of the numbers that you have are guesstimates in the first place. For the level of sophistication of the projects that you are working on, these two approaches are sufficient in terms of accounting for uncertainty. So a quick recap. In this unit, we looked at the example of establishing a slime factory. We defined the cash flows for our project. I showed you how to calculate the NPV using Excel. I showed you how to calculate expected NPV values in Excel considering uncertain scenarios. And we've discussed how to interpret the results of the present worth analysis in terms of the project financial feasibility. The golden rule to remember here is if you are using the MAR to calculate your NPV and your NPV is greater than 0, then the project is financially feasible. If it is less than 0, the project is not financially feasible. If it is 0, it means that what you will earn through this project is exactly equal to the MAR, and therefore it should also be financially feasible.